Hi, I'm Tom Stelzer and welcome to Livewire's Buy, Hold, Sell. Since 1926, 17 of the top 20 US companies by annualized returns were founder-led at one point in their history. So what makes founder-led companies so successful? What should you look for in a founder? And which founder-led or formerly founder-led businesses are worth a look today? To answer those questions, I'm joined by Alan Pullen from Magellan Investment Partners and Joe Ziller from Ziller Funds Management. Guys, thanks for joining us.
Thanks for having us.
Before we get to the stocks, I've got a couple of questions for you. Joe, I might actually come to you first. You run a founder-led fund, but what exactly are you looking for when assessing founders?
Yeah, three key qualities stick out at me. We want to see a owner's mindset, we want to see frontline obsession, and we want to see business insurgency. So an owner's mindset, we want to see the founders acting like the owners they are in terms of capital allocation. For frontline obsession, we want to see a lifting up of the frontline workers, a true love of serving the customer. Picture what Steve Jobs did with the Apple stores and that customer experience. Business insurgency, this is that kind of prickly feature that founders have the need to positively disrupt. Think what Netflix did to Blockbuster, for example. There's an important caveat though, when we're looking at founder-led stocks, the average return has historically been good, as you've pointed out, but the tails of the return distribution are fat. A strong founder can generate disproportionately strong returns. A weak founder can generate disproportionately weak returns. So it's so important to discard the weaker founders and align with the top founders.
Alan, slightly different question for you. How do you navigate the transition when a founder leaves a founder-led company?
Yeah, it's a good question because founders can be the drivers of value. And in the early days of a company, and aligning with a great founder is certainly a great way to think about investing. But I think there are plenty of great companies who do move on from that founder-led model and still generate lots of value. And really, at that point, you need to be focusing on what it is they've built and how enduring is it? How reliant was it on the charisma of a founder? Great salesman, arguably Tesla, rose to prominence because of Musk as a great salesman for EVs and so on, versus building something that's enduring and lasting. And we mentioned Apple already. Tim Cook, he had a couple of transitions there, and the first one wasn't so good. But Tim Cook came in, took that from a $350 billion market cap to a $4.5 trillion market cap. And that was because of the foundation that he had built was not built on personality. It was built on building a business with strong economic moat. Competitive advantages that were enduring through time, the consumer brand and love, the links into the wearables that made switching hard, the operating system, which all the developers got used to developing, so they had the safe apps on the iPhone. And that made that enduring business of Apple going forward. So you really want to be focusing on, yes, competent management, but the underlying comparative advantages that have been built and the sustainability of those advantages over time.
We might get to the stocks now. Alan, I'll stay with you. Our first one's Palantir, which I think was founded in 2003. I think there was 5 founders, including current CEO Alex Karp and Peter Thiel. What's your call on Palantir, buy, hold, or sell?
We're a sell on this one. Again, this comes down to, they've done a really strong job at building what they have. It's a little bit less visible than the companies we like to have. We like to take our companies apart, look at those comparative advantages, test them, challenge them. Whereas Palantir is a little bit more, because they do a lot of government contracts, a lot of it to do with defense, they're not as visible on what those contracts are, what makes them tick, how they win, how enduring they are. So the information that we're getting out of that business makes it just harder to assess that length of those comparative advantages and the duration that they have. And that leads to a wider range of outcomes. When you've got a wide range of outcomes, you actually want to have a discipline around valuation and get them at that lower end. And we would argue that the market's giving them a lot of leeway at the moment, 100 times kind of earnings type thing, that we don't have that margin of safety that we look for.
Joe, Alan said there the market's arguably been a bit generous there on the visibility of earnings. I think they are up 93% year on year on the Q2 numbers, but you would buy, hold, or sell on Palantir?
Yeah, I've got a bit of a different view for this one. I'm a buy. Investing in the rails that AI will be implemented through the organisation is a key theme we really like. and this is Palantir. Palantir is the plumbing in an organization that connects disparate systems, processes, assets, people in order to get real large value from AI quickly. It could be reducing sepsis deaths at Tampa General Hospital by 50%. It could be speeding up seeing issues in transformers in power grids from days to hours or even minutes. So there's a whole range of outcome, but the commonality here, really built by the founders, is a culture of trying to solve customers' hardest problems at the coalface. And this is very surprisingly unusual for SaaS businesses, which tend to focus more on generically scalable businesses. The result of this different culture, different approach has driven these revenue and earnings that you point out, 90% plus revenue growth. Each customer spent more than 50% year on year more in the last results. And we've got Microsoft-style earnings. So these are kind of, fantastic returns from Palantir. When you take into account them in the context of valuation, the headline PE looks high at the moment, but when you have a stock providing that much value and growing so quickly, 2 years out in 2028, we've got the stock on 33 times earnings and growing at 60% per annum, and the style of revenue is long-term, sticky, half the business is commercial, really high quality business. That's a stock that we think set up to do really well.
I'll stay with you for our next stock, which is Berkshire Hathaway. Obviously, big figurehead leaving there. Warren Buffett's gone. New CEO Greg Abel. Are you a buy, hold, or sell on Berkshire Hathaway?
We're a hold. Warren Buffett, the greatest of all time, took a failing textile mill business worth about 15 million, turned it into a $1 trillion kind of cash flow juggernaut. But very respectively, the time to own Berkshire in our view was the first half of the journey, not the second, and it really ties into an important part of our investment process. Every business, and they're all different, has a different level of friction to growth that they start hitting. Berkshire has hit that level of friction. When you hit that friction, it's hard to generate an attractive return on your capital. Berkshire has massive book, about $700 billion, and generally speaking, they can't earn a return on that above 10%. Our investment criteria, you need to be earning a return on that capital above 20% per annum. On top of that, with the transition of, the greatest of all time, we're a hold.
Joe said there, the goat's out. Alan, what's your take on Berkshire Hathaway?
Well, this goes back to a little bit what we were talking about before. How important was Warren and how important is the comparative advantages in the business he built. And he was important. So, you hear me talk about comparative advantages. We're taking, Buffett speak, economic moat. That's how we invest our clients' funds. And Berkshire has built those enduring economic moat. The float, which is the key part of why they're actually able to earn pretty attractive returns on capital. So I'll go to real returns and invested capital are really strong because of the free leverage they get from the float. So you have to adjust for that, in our opinion. And they deliver, that's enduring going forward because they have those well-established insurance businesses, disciplined underwriting that's come from the culture of Berkshire Hathaway. Then you've got, at the moment, about 300 billion of funds on the balance sheet actually not earning any return, just earning a cash return. That makes this look a lot different to a lot of other companies we talk about in general. Everybody's talking about the tech companies and AI companies. If there is a downturn, and the market is pretty rich right now, that buffets the downside because they're doing buybacks. They're going to continue to ramp those buybacks because they're at fair value according to Warren Buffett. I take his, that's our view, that it is reasonably valued on a conservative assumptions, and that's his view too. So he will ramp the buyback. So you actually get you get some upside here with very little downside because if something does go wrong, they're just going to do the buybacks. So really important from a portfolio perspective as well.
Alan, I'll stay with you for our final stock. It's Latin American e-commerce giant Mercado Libre. I think it was founded back in 1999 by Marcos Galperin. Are you a buy, hold, or sell there?
I'm going to go with a hold for this one. It is a very good company. Again, have built strong positions in Latin America, Argentina, Brazil, Mexico, in both kind of e-commerce as well as financial services and payments. So it's just a tough area to be operating in, Latin America. And that, again, gives you a wider range of outcomes. You're getting a tax on the e-commerce businesses there. It's very competitive. Amazon is in there. You've got some Chinese players as well pushing into those markets. And MELI constantly has to kind of get its margins impacted to respond to this. And then they're offering credit at the lower end of the credit spectrum in emerging markets. And I'm a former banks analyst. That can be a dangerous game to play. So, we'd want to see them go through a few credit cycles because they're at the pretty early stages of that before we got confidence that they could handle the credit assessment at these pretty subprime sectors. So a wide range of outcomes, just given those aspects. And so why not hold? There's opportunity, but there's a lot of risk as well.
Joe, I think it's down 18% in the last 12 months. I think margins have compressed a bit there as well. What's your take on Mercado Libre?
We're a buy. Alan pointed out a few of the great platform businesses of the world expressed in LATAM with e-commerce, payments, credit, advertising, logistics. So we really like that. And we really like how thoughtfully the business was built by Marcos. There's a bit of a story that every time a new project came across his desk, he would always ask, how does this impact the customer experience first? And if it didn't improve it, he canned the project, and then there was the financial assessment. And so what you ended up getting is a really high quality, sticky flywheel of business in a relatively competitive market. But what we see is when competitors like Amazon provide e-commerce incentives, they get a bit of market share, but then they lose it after they take the incentives back. Mercado Libre doesn't lose it because the quality of the relationship they built with their customer. The result of all this is the 30th quarter of over 30% revenue growth that Mercado Libre has earned. So really impressive kind of growth coming out of there. As Alan points out, one of the key things that we're watching for, despite being a buy, is credit quality in terms of that stock.
We've also asked our guests to bring a founder-led company they're backing at the moment. Joe, I might come back to you. What do you have for us?
Yeah, I've got Roblox. So that's a buy for us. They're the dominant global gaming platform for young people, going through a little bit of an interesting transition at the moment that we like. So in terms of Roblox, just to clear it up from the start, Roblox is not a game developer. They are the platform that produces the users generate this content, these games on the platform. So the economics of the business is much more akin to a YouTube or a Meta, and it creates this flywheel of users, content creators, developers making these games, making this social graph, which is a flywheel that's very compelling to us in terms of the value of the platform. What's happening at the moment is kind of two interesting changes. The first is that Roblox has changed the algorithm that provides users the ability to search for a game, to prioritize long-term engagement versus short-term monetization. And we've seen child safety verification age checks come on. Both these things, really important for the long-term prospects of the business. A common approach we see from high-quality founders, despite impacting short-term financials. So Dave Baszucki, the founder of Roblox, has been doing this for 22 years, making these trade-offs for 22 years to maximize long-term growth at the expense sometimes of short-term earnings. So if you have the patience there, we think Roblox is really attractive.
Roblox is Joe's pick. Alan, what about you? What's your pick?
So I'm going with Intercontinental Exchange. So this is a founder-led business, as you said, launched by Jeff Sprecher. He actually bought a near bankrupt kind of power trader called Continental Exchange back in '99. Paid $1,000 for it. Today, it's an $80 billion company. So, he has done a remarkable job in digitizing markets effectively. He's seen where the opportunity was to move from open outcry and futures and exchanges into electronic trading and digital trading. He's bought a number of kind of exchanges along the way, turned them from these open outcry pits that you used to remember on TV, if you're my age, into these digital exchanges. Volumes go through the roof. They're very strong, moaty businesses because of the liquidity begets liquidity. He built clearinghouses off the back of them and just built an amazing business and started in exchanges, which is still the largest part of that business. Incredible margins, over 70% margins, so they print money. They do well when things are volatile. So, when you see Trump, doing his wars and so on, impacting the oil prices, they tend to do well because they do a lot of energy trading. But they've taken this playbook of digitizing markets and moved into fixed income. They recently just bought Market Access, another a fixed income trading platform to put together with their data assets there, so they have a complete suite. And they've done the same thing in mortgage tech in the US. So mortgage origination, mortgage servicing is still a very paper-based business in the US. It's very clunky. And again, they've put together an end-to-end digital solution through that. So quite diversified now, just a giant in the exchanges space.
That's all we have time for today. Thanks to Alan and thanks to Joe, and thanks for watching. For more Buy, Hold, Sell, make sure to check out our YouTube channel.